Welcome to Tax Show Radio with your host, Don V. Don's breaking down the tax code in ways that everyone can understand. Whether you're an individual or running your own company, Don teaches you how to make better decisions so you can take control of your financial future. Tax Show Radio, only on Global Voice Broadcasting.
This program is produced with the understanding that the participants and guests are not engaged in rendering legal, accounting, or other professional advice. The hosts of the program assume no responsibility in connection with the use of information that is presented. Tax laws are constantly changing and are subject to differing interpretations. In addition, facts and circumstances in individual situations may not be the same as situations that are discussed on the program. The listeners should do any additional research necessary to ensure that he or she is fully informed before using any of the information and advice that may be given during the course of the program.
That's my guest, Joe. He's going to talk about, Joe.
Well, we're going to talk a little about retirement.
That's right.
Taxes, longevity, and the costs associated with living longer.
Very good. Okay, Joe, so I have this other one I want to show you now.
All right.
Okay, so this one talks about your tax rates.
Mm-hmm.
Making your who's your silent partner in this one?
Well, I call them silent partners. That's the wonderful Uncle Sam, and of course our beloved government in Sacramento, California.
And they're not too silent if you don't pay them.
Oh boy, isn't it the truth? I've never seen a government work so efficiently as it when it comes to collecting taxes.
Did you hear that one of the countries that's not able to, and that's the reason why Greece is in trouble, because their tax collectors weren't collecting the taxes.
Oh, I see.
And that's one of the reasons why. And then the people who were paying the taxes moved out of Greece because they didn't want to pay the taxes.
Yeah.
Well, did you hear that one of the countries, and I don't know which country it is, one of the countries asked that we send our IRS people down there to help them collect taxes.
Wow.
I was going, that's scary. But yeah, their own tax collectors are, and in Germany for a while, there was a lot of tax collectors who were on the take, and so they were getting bribed, and so I know Germany's got rid of those guys. But at one time, I know that one of my employees was telling me her brother was in big trouble because he was taking bribes for not collecting the taxes he was supposed to.
My goodness!
But like I say, I thought that was real interesting that IRS is going to other countries to show them how to do it.
Yeah. I don't know whether you want to spend a little bit more time on this or move on to the next.
I have another one here I want to show.
These are top tax rates, by the way, so they're not every dollar, but they are the top tax rates.
Okay, so here's your starting point. I don't think it came out very well.
Yeah.
Tax diversification. That's where the three buckets come into point.
Correct.
Okay.
Yeah. We all are familiar with the concept of investment diversification. Wall Street marketing has made us very aware of the advantages to trying to diversify investments so that as one investment class goes up or might be going down, another investment class might be holding steady or going up to offset that. I am not a super huge fan of that. It does to a certain extent work, but there are certain situations where when the market drops, every asset class drops, regardless of how spread out you are. And I find that sometimes people get carried away with it, where they have moderate portfolios of maybe $100,000 or $200,000, and there's some advisors got them in 12 different asset classes.
Yeah.
And it's just overkill because some of them are even the same asset class more than once.
Yeah.
So I think you need to be very careful about how you diversify. It's not that simple. But yes, asset diversification it can be beneficial, and then sometimes not. But what about tax diversification? We don't talk much about that. And that really refers to, as I like to refer to, your three buckets. You've got, and this, by the way, is something that's been around for many, many years. I didn't come up with this concept of the three buckets. But you have basically three buckets of money as you move into your later years. You've got money that's taxed today, which is your income as you're earning it, or gains that you're earning on your investment. You've got tax tomorrow, which is money that you're growing, but it's being tax deferred. For example, the retirement plans that we talked about, the 401ks, the SEPs, the IRAs, the defined benefit plans, things like that. That's tax deferral. And also annuities as well, which are not tax qualified, but they also have tax deferral. And then the third bucket is the tax never bucket, which rarely comes up in financial planning discussions. Rarely. And it is vital because to have some money allocated to an account that is not getting taxed, even when you access that.
And part of that was that life insurance that you were using?
Correct. Section 7702 of the Internal Revenue Code has been around since 1984, and it protects the growth of money inside an account that qualifies as a life insurance plan. Today, those accounts can be tied to the market so that you actually can achieve market performance and not pay tax on it
Right.
as it accumulates.
Yeah.
And that's what we're referring to here as a tax never bucket.
Right.
That probably is a 20 or 25-minute show unto itself.
Well, I understand. Yeah.
But you can, if you have any questions about that, I can answer some questions about it today.
But that's an example of tax never.
Absolutely. In
Right.
fact, I can do. Do you remember the example we saw with the two columns, the
Right.
green and the pink? I can do one of those showing the tax never versus the taxable,
Right.
and you'll see an astounding differential.
Right. Okay. All right. Well, then, anything else you want to add before we go on to long-term care, Joe?
No, I think I'd love to talk more about the tax never bucket, but we'll do it at another show. What is being highlighted here or focused on here is that on January 1, 2013, President Obama raised capital gains taxes from the Bush rate of 15% to 20%. In addition to that, in the Affordable Care Act, or Obamacare, the bill that Nancy Pelosi indicated we didn't need to read till after it was passed, they attached, or I believe snuck in, an additional 3.8% increase in the capital gains tax in a health insurance bill.
Right.
Remarkable how things work in Washington. So the overall rate went from 15 to 23.8, which is a 56% increase. And I tell people in my workshops, if the headlines in the Wall Street Journal stated income tax rates go up 56% in one day, there would be a national outrage. But with capital gains rates, went virtually unnoticed for months. I was doing workshops in September and October of 2013, and people didn't know what was going on. So with that said, the tax never bucket, and I'll go back one quick thing on that becomes really a big focus now, because now the tax rates on gains are really high.
That's right.
So anyway, but getting back,
and one of the things you want to point out is that the California adds into that 13.3%.
When I saw this, I read this in 2013. I had to sit down, and believe me, after 40 years of practice, I rarely have to sit down anymore. I've pretty much heard it all, I thought. But when I saw that California was behind Denmark and France, I thought, all by itself, not even a country, right?
Right.
I thought, wow, we really do pay an enormous amount of tax in this state. So again, the tax planning in California is even, I think, more important than some of the other states we have.
Exactly. Certainly is. Okay, Joe, I want to go then to long-term care.